Hello friends, today's topic 10% tax on profits now, will it go to 30%? My name is Dr. Bharath Chandra. The purpose of the video is service to society. Yesterday afternoon, there were news reports that the central government is considering to increase capital gains tax on high income earners in 2024 or later. The news heading was India eyes higher capital gains tax for rich to curb inequality. Due to this news, Indian stock markets marginally fell in the last hour of trading yesterday. Obviously, any additional tax on stock market profits is a negative news for investors and stock markets as a whole. By late evening, the income tax department clarified that there is no such proposal to increase the capital gains tax. Although the government has denied the reports of increase in capital gains tax as of now, observing the track record of introducing new and higher taxes on stock markets, it is highly likely to happen in the future. In 2018, the then Finance Minister Arun Jaitley introduced 10% tax on long-term capital gains above 1 lakh per annum. Before that, long-term capital gains was exempt from tax for more than 15 to 20 years. In 2020, dividend received by investors from listed companies was tax-free in the hands of the investors. The government was only levying a dividend distribution tax on the companies, which was only 15% on the dividends distributed by companies. Now investors have to pay tax on dividends at the income tax slab, which could be as high as 30%, hence higher taxes for higher income people. In March 2023, the government imposed higher tax on long-term capital gains on debt and gold mutual funds. So step by step, the government has taken steps to tax on all kinds of income from stock markets or financial markets. In future, after a few years, it is most likely that the government will tax capital gains from stock markets as per income tax slab. It may not be a surprise for investors. Now, impact of capital gains tax on stock markets existing 10% and 30% long-term capital gains tax after subtracting exemption of 1 lakh per annum profit. Investment of 10,000 per month for 20 years comes to 24 lakhs. Corpus value at 15% returns before tax is 1.51 crore. Corpus value at 15% returns after 10% tax is 1.38 crores and effective returns after tax is 14.32%. Now, same calculations, corpus value at 15% returns before tax 1.51 crores, corpus value at 15% returns after 30% tax is 1.13 crores and effective returns after the tax 12.96, though we made a profit of 15%. Many people who are slightly weak in mathematics may make the mistake of calculating in the following way. Returns 15%, tax 10%, effective returns is 15 minus 10 is equal to 5%. Some people may calculate like this when the tax goes to 30%. Returns 15%, tax 30%, effective returns 15 minus 30 is equal to minus 15%. You need to note that when compounding happens, we cannot directly subtract the tax rate for the returns. We need to calculate the corpus value after appreciation, then reduce the tax amount, then calculate the effective returns after tax. Bank FD interest is already taxed as per tax slab, and assuming 30% tax, let us calculate the final value after tax. Impact of capital gains tax on bank FDs. Investment in RD 10,000 per month, 24 lakhs. Corpus value at 7.5% returns before tax 55.72. Corpus value at 7.5 returns after 30% tax 46.21. Effective returns after tax 5.59%. Now, comparison of FD and stock markets after 30% tax. 24 lakhs invested as monthly investment of 10,000 for 20 years. Instrument FD and effective returns after tax 5.59%. Now stock markets corpus value before tax at 15%, 1.51%. Corpus value after 30% tax comes to 1.13 crores. Effective returns after tax 12.96%. Now observations and comments about today's video. The impact of higher tax on stock market gains will reduce the corpus value after tax. However, the returns will still be better than alternatives such as RD, post office, etc. 2. Currently, we are getting the benefit of higher returns and lower tax on stock market, but in future, the tax advantage may go away. 3. We have assumed 50% returns in long term from stocks. It could be more or less depending on how well you manage your investments. 4. Unfortunately, government feels it is easy to tax stock market investors since they are small in number compared to India's population, and hence it may not impact in the elections in future. They are focusing on welfare schemes for the lower income group who they want to uplift. Finally, at the end of the video, here is a question. What is the message you got from this video? Type in the comment section. If you are not the member of Stock Market Academy channel, this is the time to subscribe, press the bell icon, send the video to all your friends, and at the end, thank you for watching. Bye bye, all the best.